Most people have no idea what an annuity actually is. And honestly, I don't blame them. The word annuity gets thrown around a lot. But here's the problem, it's not one singular thing. That's a catch all term for a wide range of financial products offered by insurance companies, some of which are useful and many of which are well complete 100% total garbage. There are variable annuities, fixed annuities, indexed annuities, immediate annuities, and lots of variations of all of those. And they all fall under the same umbrella of this annuity, but they all behave very differently. And too often that leads to confusion and some really, really bad decisions. Most annuities, the simple way to put it, they're bloated, they're complicated, and they're overpriced. And they're often sold with some slick marketing, some shiny guarantees, and lots of promises that often fall apart once you read the fine print. But there's one type of annuity I actually like, a simple one that does exactly what it says it will do. And in this video, I'm going to show you how it works and when it actually makes sense to own this in a retirement plan. When someone says the word annuity, most people think of something they should stay away from, and they're usually right. Annuities have become a bit of a dirty word. And honestly, that's for good reason. I often somewhat jokingly say that there's two types of people who can benefit from an annuity, those who sell them and those who own stock in the insurance company that created them. And really, that's only slight hyperbole there. Now, before we go any further, let me be crystal clear. This video is not me trying to sell you an annuity. Yes, I do have an insurance license, but that's because the firm that I was at required me to get that day one. And since then, I've been grandfathered in. I no longer even have to do continuing ed for that license. So there's no reason to get rid of it, but I'm only licensed in a very small handful of states. And, I only use it in very narrow situations with established clients when this fits their plan. In fact, I think insurance products accounts for about 3% of the total assets we manage. So this video certainly isn't meant to be some sort of sales pipeline to get people into our products. It's simply a tool that we use when it makes sense, and only then. So if you're hoping for a pitch, and I know that there's nothing people like better than a pitch for an annuity, right? Well, you're going to be disappointed today, but what you are going to get is an honest breakdown of what I think is garbage, what's useful, and how to think clearly about annuities without the sales pressure. Part of my disdain for annuities is that I like to keep investing simple. The investments you have should never be your plan. They should always be a slave to your plan. You should be able to point to any investment in your portfolio and answer the question, how does this piece serve the needs of my plan? So, for starters, if you're buying an annuity and you don't have a solid retirement income plan in place, you're already in trouble and the cart is ahead of the horse. So, before you even think about buying any product, make sure that you have a solid plan in place for your retirement. And speaking of retirement income plans, I want to make sure that you've got something that can help you see the big picture. Because if you're watching this, you're probably either close to retirement or you're already retired. I put together a free guide called The One Critical Portfolio Shift You Must Make Before Retirement. It's going to walk you through one of the most important changes you need to make as you move from the accumulation phase to the retirement income phase. And if you're in that 5 to 10 year window before retirement, this shift is critical, and it's one that a lot of retirees miss. Now, this guide is going to help you to think more strategically about how each piece of your portfolio fits into your overall retirement plan, whether you're using an annuity or not. Now, you can download it for free. It's going to be down in the description. A link is it's a short, clear read that could save you from making a costly mistake just because you didn't see the full picture. So before we get into the one type of annuity that I like, let me quickly point out the other two most common annuity types and what gives the word annuity such a bad reputation. So let's start with variable annuities. Now, these are notorious for high fees. And let me back up just a second. I'm not going to go into a deep definition of all of these. I just want to briefly cover these. All right? So there's a lot to know here, a whole lot to know. But variable annuities are known for really high fees. Most of them that I see come in that we're reviewing are, 3 to 4%. When you add up all of the different expenses between the mortality and expense fee, the rider fees, the sub account fees, that's usually about where they fall in that 3 to 4%. And speaking of those riders, they usually are loaded up with some confusing riders that sound great, but in many cases, they really do very little in practice. You know, it's effectively a guarantee that will send you back your money or something like that. And then you have the indexed annuities, you know, equity index annuities, fixed index annuities, pretty much the same thing. They promise these market link returns without the risk, but what you usually get are participation caps that are really unclear. There's crediting methods that are also unclear, and usually plenty of opportunities to be disappointed 3 to 4 years down the road after you buy it, but you're still locked into a 7 to 9, year surrender period. And don't get me started on these so called lifetime income guarantees that are in there. Many of those are just clever ways to get you locked in while giving you less income flexibility than you think and what you may have had outside of that annuity. And then, worst of all, a lot of annuity recommendations are driven by commissions, meaning the product that's right for you just happens to be the biggest check to the person selling that. So, what you also have to know is that many of these have a 6 to 7% commission rate attached. And so, if someone's talking to you, about your $1 million IRA and how you need to make sure that it's ready for the market correction that's coming, just know there might be a $60,000 check attached to that for that person selling it. Now, I'm not against people getting paid, but you do need to understand where some of those incentives are. And you know what? I'm painting with a broad brush here, for sure. There are certainly outliers in the variable annuity and fixed index annuity world that may be okay in very specific, isolated circumstances, but for the most part, my opinion is that these products are just plain garbage. Now, that said, not all annuities are bad, and I think it's unfortunate that the badness of those annuities cast bad light on every annuity out there. There's one kind that I think deserves a spot in the right retirement plan, and it's called a MA, which stands for Multi-Year Guarantee Annuity. So you'll hear me refer to this as MGA, and if you read in other places, you'll hear it called MA as well. So MYGA, Multi-G Guarantee Year, Multi-Year Guaranteed Annuity. And unlike the others, it's very simple. Here's how it works. You give an insurance company your money, and they agree to pay you a guaranteed interest rate for a specific number of years. There's no market risk. With fluctuating stock market, there's not going to be participation rates, confusing riders, no gotchas. Now, some of those do have some riders that you can add to that, and there are occasionally a few gotchas. You just need to stick with the ones that are simple that don't come with all of the bells and whistles. Most of them just have a very plain promise, and that is you give us your money and we'll give you interest period. So you have to think of them like a CD that's offered by an insurance company just minus the FDIC insurance, right? So, because most of these annuities aren't covered by FDIC, MIGAs often have a higher interest rate, especially over that 3 to 5 year term. And that's because insurance companies don't have to deal with the same regulatory constraints that banks do, and they can usually invest in a broader set of fixed income assets to support that yield. Now, before you rush out to buy one, I know after this talk, this has been so riveting that you can't wait to add one of these to your portfolio, but there is something incredibly important that you need to understand, and that is do not exceed your state insurance guarantee limits. Insurance companies, and yes, even the large and respected ones, can get into financial trouble. For those of you that are around in 2008, 2009, you remember some of those names that did get into trouble. And if that happens, you don't want to be holding an annuity that exceeds your state's coverage limit. Now, every state has a guarantee association that provides some level of protection if an insurance company goes belly up. You can find your state's limit by going to the website for the National Organization of Life and Health Insurance Guarantee Associations. Or you could just do a quick online search for, your state, Texas, for example, Insurance Guarantee, Annuity Guarantee Association, Texas Guarantee Association, and you're going to see that come up there. Now, a lot of these states offer different guarantee amounts, right? Or different coverage amounts. In some, it's up to $250,000 per person. Some, it's $300,000. Some have different coverages for trust, for joint accounts. So you do need to go in there and read that and make sure that you are staying underneath that coverage. Now, here's one of the catches here. Most states prohibit agents from using the existence of this protection as a selling point. So you're never supposed to hear something like, oh, don't worry about this insurance company. It's covered by the state. That's not how this works. But as a consumer, you do need to be aware of the state guarantee limits and understand the limits. I've heard the stories and seen the statements of people who bought an annuity from a well known firm that's still very well known to this day, that's huge in an amount that was several times over the coverage limit. Please don't do that. There's no reason to take that risk. Insurance companies can and do get into financial trouble. So, when does a MGA actually make sense? Well, I think there's a few situations where it can be a smart fit. So, for example, if you're holding cash that you know you won't need for the next 3 to 5 years, AMGA might be a better home for that money than your savings accounts. The rates are often significantly higher, and if you're locking in a higher return for a defined period, that could be a better thing as we see yields potentially slip over the next 3 to 5 years. But where we often see MA shine is within a bucket strategy because you can choose specific terms like 3, 5, or even 7 years, and that can be timed to match a planned need for income. Now, to be clear, you can also do this with CDs or bonds, but sometimes it can be hard to find the rates on CDs or bonds that you can with these MIGAs. And then for risk averse investors, people who don't want to deal with market volatility, but they also dislike the idea of getting 0.5% in the future if we see rates drop. Mass do offer a comfortable middle ground. There's not going to be a roller coaster ride with these, just a fixed rate that you can count on, and then plus, Mass also offer tax deferral. That means that you don't owe taxes on the interest until the end of the term. Now, that can be harmful and helpful, but if you're aware of that, you can manage your taxable income today and push that liability a few years down the road. And where I've seen that come into help is if someone has a maybe a large brokerage account and they want to get all the interest they can, but maybe the interest coming off that brokerage account is going to disqualify them for the premium subsidy for their ACA plan. That could be a good way to push that income out down the road. Now, of course, MAS aren't perfect and they're certainly not for everyone. If you need liquidity, needing to get to that money before the term is up, a MAGA probably isn't right for you because they're going to have a surrender penalty attached if you get to them, in that period that it's set aside for. And if you're looking for growth or some kind of upside potential, this is not going to do it for you. It's certainly not designed to beat the market. It's designed to beat the bank, with more simplicity, more structure, and probably fewer strings attached than some of the other products that are out there, but it's going to do pretty much just what it says. So, if it's paying you 5.2% for 5 years, guess how much you're going to get? 5.2% for 5 years. No more, no less. Look, you don't have to love annuities. I can tell you I don't. But that doesn't mean that all annuities are bad. I think MYGAs are the exception. They're clean, they're simple, and for the right person, they do exactly what they're supposed to do. No surprises, no sales gimmicks, just peace of mind and a fixed return you can count on as long as you stay within your state limits and you buy smart. So, let's wrap this up. I know annuities get a bad rap, and frankly, most of them deserve it. The industry has made them complicated, expensive, and very easy to misuse, and too many are designed to confuse you while enriching someone else. And I don't like that. But that doesn't mean every annuity is bad. Amiga is the rare exception. It's simple, it's transparent, and it can play a very specific and useful role in a retirement plan when it's used correctly. It's not a growth engine, not a miracle product, but for the right person in the right situation, it can quietly do exactly what it promises. It gives you a safe, stable return without the drama of the stock market. And sometimes that's exactly what your plan needs. So just remember, like any tool, it only works if you're using it the right way. So don't rush into anything. Don't chase a rate without understanding the trade offs. And please, whatever you do, stay within your state guarantee limits. If you're in that 5 to 10 year window before retirement, now is the time to start putting these pieces together. I hope this information helped you. Hit the like button and subscribe to the channel to promote this type of videos so that others can find it too. Thanks so much for watching.